If you're still trading support and resistance the way everyone else does, you're being hunted. Every stop loss you place, every breakout you chase, smart money is one step ahead. In this video, I'll show you how liquidity really works, the two zones institutions target, and how to trade with them, not against them. We'll break down real chart examples, apply powerful filters, and reveal the truth behind supply, demand, and fair value gaps. This is how smart money trades. So, what is liquidity? Liquidity refers to clusters of stop losses, pending orders, and breakout entries around key price levels. These orders create the volume smart money needs to enter large positions without causing major price moves. But smart money doesn't enter randomly. They need traders on the wrong side. That's why they target areas loaded with stop losses and breakout orders, known as key liquidity zones. Let's start with the most common, support and resistance. Most traders expect price to bounce from these levels. Smart money sees liquidity, not entries. Above resistance we find buy-side liquidity, buy stops from breakout traders, and stop losses from short sellers. Below support we find sell-side liquidity, sell stops from long traders, and breakout entries from sellers. This type of liquidity is known as stop-loss liquidity. It's the fuel smart money uses to enter or exit large positions. They drive price into these zones to trigger those stops and then reverse the market. So, what are support and resistance levels? They're zones where price has shown clear reactions before, either rejection or reversal. They act as potential decision points, not guarantees. We draw them to highlight where liquidity builds and where traps and reversals often occur. But not every level is valid. Here are 6 filters to identify high probability support and resistance zones, the kind smart money hunts. Clear swing highs and lows. Look for recent extreme points, the most obvious highs and lows before a reversal. These zones attract orders and often act as liquidity magnets. Multiple rejections. The more times price rejects a level, the more traders notice it and the more liquidity gathers just beyond it. Visually obvious levels. Good zones should stand out instantly. If you need to force it, skip it. Obvious levels attract the most attention and the most orders. Strong reactions or sharp moves. If price launched aggressively from a level, institutions were likely involved. These zones tend to get revisited later, perfect for liquidity sweeps. Role reversal. Support becomes resistance, or vice versa. When a level flips roles, it leaves trapped traders behind, adding more stops and more opportunity. Recently respected levels. Focus on zones that were tested or formed recently. Fresh levels reflect current market sentiment and are more likely to attract liquidity. You don't need all 6, but the more a level checks off, the more powerful it becomes. Alright, take a look at this US dollar Swiss franc 1-hour chart. Notice how the price comes down, touches this level and reverses. Then it pulls back again, hits the same level and reverses once more. And again a third time, price reacts and bounces upward. This level has now been tested multiple times, and that's the first sign of a high probability liquidity zone. Why? Because multiple rejections mean multiple traders placing stop loss orders just below this level and even limit buy orders stacking up around it. In other words, there's sell-side liquidity building beneath this support. Now let's add in the second trait. This level also lines up with the extreme swing low. It's the lowest point on the chart in recent time. That makes it even more attractive for retail buyers expecting another bounce. What does that mean for us? More stop losses below the low, more limit buys in the zone. In short, a perfect liquidity trap. Third trait? It's obvious. Anyone opening this chart, beginner or advanced, will spot this support level immediately, and when a level is that obvious, it becomes a hotspot for orders. That's exactly what smart money looks for, crowded areas where they can trigger a liquidity sweep. Now, watch what happens next. Price pulls back, then breaks below the support, triggers all those stop losses, grabs the liquidity, and then reverses with strength to the upside. This is a classic liquidity sweep. Smart money pushes price just below the level to fill large orders, traps breakout sellers, and then drives price in the opposite direction. So when you spot a level that meets these traits, obvious, multiple rejections, and a swing low or high, don't rush to enter. Instead, wait for the sweep. That means a break below the level, followed by a strong close back above. That's your signal. Now let's look at another example, this time on Bitcoin versus the US dollar on the hourly chart. Notice how price moves up and hits a clear high before reversing. That high marks an extreme swing point, and it's our first clue that this is a high probability liquidity zone. When price forms a clear swing high like this, it naturally attracts attention. Traders start placing limit sell orders at the level, and those already in short positions place stop losses above it. This creates what we call a buy-side liquidity zone, an area full of orders waiting to be triggered. Now look closer. This level is also obvious. Anyone opening this chart can see it right away. And when a level is obvious, it becomes crowded. The more visible it is, the more orders it attracts, and that means more liquidity for smart money to target. Another key trait? This level was recently respected. Price reacted here just a short time ago, which gives traders even more confidence that it'll act as resistance again. So more sellers enter, and more stop losses get placed just above. Now watch what happens. Price pushes up, breaks just above the resistance, sweeps the buy-side liquidity, and then drops sharply. That's a textbook liquidity trap. Smart money triggers the stop losses and breakout buys, fills their sell orders, and reverses the market. As a smart money trader, your goal isn't to predict the breakout, it's to wait for the trap. Once you see price sweep above the level and then close back below it, that's your entry signal. The first type of liquidity we covered is stop loss liquidity, found above resistance and below support, where retail traders place their stops. Now let's move to the second type, imbalance liquidity. What is imbalance liquidity? It forms when price moves aggressively in one direction, creating a clear imbalance between buyers and sellers. These fast moves often leave behind unfilled institutional orders, turning those areas into liquidity zones. When price returns, smart money uses these zones to complete unfinished business, filling leftover orders, reloading positions, or trapping retail traders. These areas are known as supply and demand zones. A demand zone forms after a sharp move up, leaving unfilled buy orders below. A supply zone forms after a sharp move down, leaving unfilled sell orders above. Smart money often brings price back into these zones before continuing the move, either to trap early entries or collect more liquidity. But not all supply and demand zones are created equal. Some are strong and reliable, others are weak and noisy. The difference comes down to 3 key filters. Master these and you'll stop wasting time on low-quality setups and focus only on zones with true imbalance. The first sign of a strong supply or demand zone is the size and consistency of the candles in the move. Large, clean candles in the same direction suggest institutional activity. Small, choppy candles with lots of wicks? That's noise. Skip those zones. Freshness of the zone. Only trade zones that haven't been touched before. The first test is usually the strongest. Once price revisits a zone, it gets rejected and the market reverses strongly. Break of structure. A strong zone often forms after a break of structure, like a previous high or low. These breakouts are not random, they signal a shift in control, often led by smart money. Zones formed right after are high probability. Now, let's apply this on a real chart. We're looking at the British pound US dollar 15-minute chart. The market just made a sharp move upward, creating an imbalance zone. Why is this important? Because strong one-sided moves often leave unfilled institutional buy orders behind. Smart money may return to this area to fill those orders before continuing the move. But is this a high probability demand zone? Let's apply the 3 filters. Filter number 1, candle size. The candles in the move are large and consistent, a clear sign of institutional momentum. Filter number 2, freshness of the zone. The zone hasn't been tested yet, which means the first touch could trigger a strong reaction. Filter number 3, break of structure. Looking left, the move broke a previous high, confirming a shift in structure and adding strength to the zone. With all 3 filters in place, this is a high-quality demand zone, a strong liquidity level we can trade from. So we mark the zone and wait. Watch what happens. Price pulls back, taps into the zone, fills the unfilled orders, and explodes upward. As smart money traders, we wait for confirmation. Like this rejection wick showing buyer interest at the zone. That's your signal to enter and follow the move. Now let's look at another chart example. This is the Euro US dollar 15-minute chart, and the market has just made a sharp move downward. This strong drop creates a clear price imbalance, making it a potential supply liquidity zone. But is the zone valid? Let's apply the 3 key filters. Candle size. The candles in this move are large and consistent, a clear sign of strong selling pressure from institutions. Freshness of the zone hasn't been tested yet, That means it still holds unfilled sell orders, and if price returns, those orders could drive the market back down. Break of structure. The move broke a previous support level, confirming that this wasn't just a pullback, it was a structural shift driven by smart money. With all three filters in place, this is a valid supply liquidity zone. So we draw the zone and wait for the price to return. Watch what happens. Price moves back up, taps into the supply zone, gets rejected, and then drops sharply. That's exactly how smart money re-enters the market and how we position ourselves with them. Now let's move on to another type of imbalance liquidity zone, the fair value gap. So what is a fair value gap? A fair value gap is a price imbalance created when the market moves aggressively in one direction, leaving a gap between candles where no transactions occurred. This gap represents inefficiency in the order flow, an area where buy or sell orders were left unfilled. Smart money often returns to these zones to fill those missing orders. That's why the fair value gap is considered an imbalanced liquidity zone. It holds resting liquidity that attracts price for a retest. For traders, it becomes a high probability area to anticipate reactions and enter with precision. How to spot a fair value gap? Look for 3 consecutive candles. Focus on the middle one. It should show a strong move either up or down. If the high of the first candle and the low of the third candle don't overlap with the middle candle, a gap is present. That zone, from the first candle's high to the third candle's low, is your fair value gap. Mark it with a rectangle, that's your zone of interest. Fair value gaps can form in both directions. Bullish fair value gap, created during sharp upward moves. Bearish fair value gap, forms during strong drops. If the first and third candles overlap with the middle candle, there's no valid fair value gap, no matter how large the middle candle is. There are 5 criteria for identifying a valid fair value gap as a liquidity key level. The first criterion is the gap must be unmitigated. A valid fair value gap should be unmitigated. In other words, virgin. This means price has never returned to test or fill that zone. When the gap remains untouched, it suggests that unfilled institutional orders are still resting inside, making it a powerful liquidity magnet. Smart money often comes back to these zones to complete unfinished business. Once the gap is filled, the liquidity is consumed, and the zone loses its strength as a key level. The second criterion is the size of the fair value gap. Larger fair value gaps indicate a stronger imbalance, meaning more unfilled orders were left behind. The bigger the gap, the more significant the liquidity it holds. When multiple fair value gaps are present, focus on the ones with the largest size. They're more likely to attract price and deliver a reaction. Avoid fair value gaps near obvious support or resistance. If a fair value gap appears just below resistance or above support, be cautious. Those levels act as opposing liquidity pools. If price hits them first, it may reject sharply and invalidate the gap. A clean liquidity zone should stand on its own, not clash with nearby structures. Fair value gaps after break of structure are powerful. When price breaks a key level and immediately forms a fair value gap, that zone often marks where smart money re-enters. These gaps are filled with unexecuted orders left behind by the aggressive move. The first retest of this type of fair value gap often leads to a strong reversal or continuation. It's one of the most reliable liquidity-based setups. Wait for confirmation from price action. The presence of a fair value gap doesn't guarantee a reversal. It simply marks a potential liquidity zone. To validate it, wait for a clear reaction, such as a strong rejection candle or a reversal pattern. If price reaches the gap and shows no sign of rejection, avoid the trade. Smart money reacts with intent. So should we. Now let's look at a chart example. This is the US dollar JPY daily chart, and as you can see, the market is in a clear uptrend. Here we have a textbook fair value gap. This is the first candle, the second candle shows a strong bullish move, and the third candle's low doesn't overlap with the high of the first, creating a visible price gap. This gap qualifies as a valid imbalanced liquidity zone because it's unmitigated, price has never returned to it, it's large, indicating a strong imbalance, and it's located away from major resistance, which avoids conflicting liquidity. But is that enough to enter a trade? Not yet. We still need the market to retrace into the gap and show a clear reaction, such as a strong rejection candle. If price touches the fair value gap but shows no reaction, the setup is weak and should be ignored. Now look what happened. Price came back, tapped the fair value gap and printed a clear bullish pin bar, a strong sign of rejection. From there, the market continued upward with momentum. Here's another example, this time on the US dollar Canadian dollar 15-minute chart. The market is clearly trending downward and has just formed a fair value gap. Let's check if this gap is valid. The low of the first candle and the high of the third candle don't overlap with the strong middle candle, so the gap meets the structural criteria. The gap is unmitigated. Price hasn't returned to test it yet. While the size isn't large, it's acceptable and still shows imbalance. But that's not enough. As always, we need confirmation. We wait for price to retrace into the fair value gap and watch for a strong rejection. Now look at what happened. Price retraced, tapped the gap and immediately rejected it, then continued dropping. This rejection signals that the market respected the imbalanced liquidity zone and that unfilled sell orders were likely executed there. Now let me ask you an important question. What if you find both a supply zone and a fair value gap at the same time? Which one should you trade? Let's break it down with examples. In this first example, we have a clear supply zone. It meets all the criteria of a high probability liquidity zone. Strong candle momentum, fresh zone, break of structure. But right below it, there's also a fair value gap. So which one do we focus on? In this case, the answer is simple. We prioritize the supply zone and ignore the fair value gap. Why? Because the supply zone represents a true area of institutional selling, where smart money likely place large orders. It has stronger structure, more confluence, and holds deeper liquidity than the fair value gap in this context. Let's look at another example. This time we have a strong demand zone and just above it there's a fair value gap. Same principle applies. We ignore the fair value gap and focus on the demand zone. Fair value gaps are important, but when a clean, high-quality supply or demand zone is present in the same region, it takes priority. Think of fair value gaps as secondary liquidity zones. They're valid, but only when they're not competing with a stronger structure like a supply or demand zone that meets all three filters. So always ask yourself, which zone has more evidence of smart money activity? If the supply or demand zone checks all the boxes, that's where you want to focus your trade. Now you know how smart money targets liquidity and how to spot the zones that actually matter.